This study from Dalbar tells you a lot about an average investor's mistake in the stock market. So, what this chart tells you is that an average investor kind of underperforms a buy and hold strategy because they exit the market at the wrong time. So you can see over 30 years, there's an underperformance of about 7% and so on and so forth. Like 10 years and 12 months also doesn't make a difference, right? Because as humans, we tend to kind of exit the positions at the wrong time, right? Like it's mentioned in the article, trying to time the market is incorrect approach as we usually sell when we should not. Example, October 2008, and are out of the market when we should be invested. Example, March 2009. So you might say, so buy and hold is great, but it also comes with a lot of risk. With a lot of risk, as investors, we become very impatient after a point, right? What happens if this drawdown keeps on continuing, right? You don't know when this pandemic or like a crisis is going to end, right? So when you're going through that period, it's very difficult to stomach that loss. So to avoid these kinds of human errors, right, we are going to discuss two risk management strategies in this video. One is volatility based, another one is momentum based. So volatility is simply you're invested in the stock market, and when the volatility goes enters the highest quartile, so you calculate this on a rolling basis, and if it enters into like highest quartile, you exit the position, right? So let's say you're simply invested in S&P 500. If the volatility gets to a highest quartile, you either move it to cash, right? Or you can get some move it to like a yielding fixed income product as well, right? Where you can generate a decent amount of returns than having it then cash. So and here is the performance, right? And by the way, both these strategies, don't look at it from a performance aspect of it. The main goal of both these risk management strategies is to help you reduce the drawdown, help you reduce the risk, right? That's the goal. But also, at the end of the day, if the returns are superbly worse, then also it doesn't make sense, might not make sense as well, right? So to an extent, yes, you should look at the returns, but the main goal of these two strategies is just to reduce the drawdown, right? So S&P 500 versus the volatility filtered S&P 500, right? So basically, when the volatility enters the highest quartile, you move into cash, right? By the way, the returns in the volatility filter, the blue line, is a bit understated because you're moving into cash, right? Instead, if you move it to like an yielding product, right, like a fixed income, where you get a few percentage more returns, right? So it might even actually match the S&P 500 with the volatility for risk management, right? But that's not the goal here, right? The goal is to reduce the drawdown. As it done, let's look at this table here. So in this table, what it shows that the strategy itself is only invested 79% of the time in the market, and cash could be invested in treasuries, meaning like I mentioned, right? Like you can get an yielding some yield when you're instead of having it in cash, you can move it to some kind of a treasury product. So what this table tells you is that on average, the S&P 500 drawdown is 40%. Strategy, on average, it's 25%, right? You can look at it on various periods, right? These are like so between like 2007 and 2017, right? The maximum drawdown, this is during the financial crisis, right? It's 53%. If you had implemented the volatility filtered strategy, it's only 13%. That's a massive, massive reduction, right? So risk management, it helps you do this, helps you reduce the risk massively, right? And this is a very kind of like a strategy that you implement it on a month over month, like monthly basis, right? You don't do this on a daily basis, and because then it becomes even more difficult to manage this portfolio. So every month you kind of like look at the volatility, whether it's in the highest quartile or not, and then you either stay invested in the stock market and or else you move into cash or a treasury product. So this is with regards to the volatility, right? The next one has been talked about a lot of people. A lot of research is also out there based on the momentum based risk management. So this is simply looking at the last 12-month returns, right? So if the 12-month returns, last 12-month returns turns negative, right? Let's say it turns to minus 0.2% or minus 3%, right? Last 12-month return, then you move into cash, right? And here you go. It has clearly outperformed S&P 500. Again, to remind you that that's not the point, right? The point is to reduce risk. Has it reduced risk? And the answer is again yes, right? So you go from again 40% on average maximum drawdown to 24%. Again, a massive reduction. Same goes for let's say financial crisis, right? 53% compared to 24%. So it has helped you reduce the risk, but in this case, it is also outperformed, right? Although that was not the goal. So what this study tells you is that with risk management, you can reduce your risk and helps you kind of sleep better at night when things are going sideways, right? When things are going like financial crisis, right, which was very long bear market, it helps you sleep better at night with these kind of risk management systems in place. So I've also told you that we can do this on the Indian stock market, right? This is like I've done it only on the S&P 500. The study itself is on S&P 500. So let's quickly analyze this risk management. So I'm going to do the momentum-based risk management on Nifty 50 and see how well it has done compared to Nifty 50 without the risk management, right? So I've already created a risk managed Nifty 50. So I'll just walk you through the portfolio, right? The portfolio is superbly simple, right? So I'll just go back to, let's say, 2002, right? So the ETF itself starts there. So I'm invested in the Nifty 50, right? Till 2008. So till then, there were no kind of negative 12-month returns, right? And I then moved to a short-term bond fund, right? When the returns turn negative, I move into short-term bond fund. And then once it becomes positive, so as you can see, I'm doing it only on the month ends, right? So this is not like I'm doing it every week or every month. So and then I'm again moving it to Nifty 50, so on and so forth, right? So there are only two instruments here, right? One is the Nifty 50, Nippon India ETF Nifty 50Bs, and the second instrument is the short-term bond fund. And it goes on till now. We'll take this to asset comparer and compare this with Nifty 50 without. So Nifty 50 itself there's no risk management, right? You're just staying invested in equities 100% of the time. So let's look at comparing this to a simple Nifty 50 and see how well it has done. Again, the goal is as it reduced and let's start with the performance, right? Which is very exciting to look at. In terms of performance, it has underperformed Nifty 50, but there have been times where it did outperform. So just because it has underperformed in the recent past doesn't mean that it's a bad strategy or anything, right? So let's say we are in January of 2020. This is few months before COVID. This strategy has clearly outperformed Nifty 50, right? But things have changed in the last 3-4 years, and the stock market has gone up, right? So this is the performance, right? Where there have been times where it did outperform Nifty 50, and there have been times where it did underperform. But the main goal is as it reduced risk, right? Let's go into the stress testing, right? So more importantly, let's get into the rolling drawdowns, right? The maximum amount of money that you can lose during any period, right? So one thing that you can clearly see that it has definitely protected you during the worst drawdown period of our century, which was the the financial crisis, right, definitely helped you protect money, right? So compared to Nifty 50, which went down by 53%, the risk management helped you cut losses here, right? So it went down by 22%, right? The maximum 35% to be honest, right? So it is the return that you can, the drawdown that you can see in May 31st, 2031st, yes, July 31st, 2008, and the maximum drawdown for the Nippon India, the Nifty 50s, right? So this is a monthly data chart, right? And it's like worse, right? So they definitely helped you cut losses during financial crisis, which was a very long bear market. You can also see that during 2016, it again helped you cut losses. So 2016 is where the 2016 market sell-off crisis was happening, right? So it helped you cut losses here. But this risk management strategy doesn't work all the time, right? Because it works very well during long bad markets, but not for like quick, sharp tanking, right? Like during COVID, the market went down quickly. So in this case, it didn't protect, right? Both Nifty 50 and risk managed Nifty 50 went down by the same time, right? So this is something to be aware of, right? And if we go into the returns, so we can see the maximum drawdown here, 38% compared to 60%, right? There's a massive difference, right? 60% versus 38%. There's a big difference. There's a huge amount of risk that you're reducing by going with that risk managed 50-50, right? And you can see in terms of CAGR, I mean, I would still say not bad, right? You're getting with all the risk 15.42% compared to 14.15%, right? Let's look at the risk adjusted return, right? The Sharpe ratio. I'm hoping it's better. Sort of similar, right? It's the point you're getting it with lower volatility, lower drawdown, a few percentage lower in terms of CAGR, right? But that's the price that you pay for, stomaching less risk. Mind that this stock market, that is Indian stock market, has been going up and up forever, right? Similar to Nifty 50 or similar to S&P 500 or the US market. There could be times where the stock market doesn't move at all, or maybe it just goes down and down, right? Like the Japanese stock market. During that time, risk management is probably the best strategy, and you would be thanking me or thanking this strategy later. That's it for this video. I just want to quickly explore this idea of risk management and discuss with all the Indian investors, advisors, and mutual fund distributors out there, just to explore this idea of risk management, which has been explored and studied thoroughly in the various different markets, especially the US market. There's enough research on that. So I just want to quickly analyze the Indian stock market and apply the same risk management to the Indian stock market using our tools, which you can easily create any sort of risk management strategy quickly, right? Using the dynamic portfolio that I just showed you in the dashboard. That's it for this video. Thanks a lot for watching, and I will see you next time with another interesting concept. Thank you.